All right, it's a pleasure to be here. It's been a few years since I came, and it's sort of nice to see that there is a combination of people that I was coming to this conference with 25 years ago, and also a lot of new people. So it's a pleasure to be back. Hopefully I'll be able to use the clicker. We'll see what happens. So the paper. Just as a brief introduction, I think this is a really nice paper. I mean, you've got a pretty good idea from the discussion that we just had. There's a lot of work that's gone into this paper. It's very nicely written, very clear. There's a model as well as the reduced form stuff. So lots of really nice stuff here. And the basic message I think is very significant. So mostly I'm just going to have a few sort of questions about things that might be addressed, but no fundamental questions. So what is the paper about? So the conventional wisdom is that fintech increases competition and hence inclusion, and that seems pretty clear. It reduces transaction costs. It makes things more competitive. Fine. However, there's a difference in how digital platforms affect the banking of different sectors of the population. So in particular, digital platforms are mainly used by younger, richer, and more educated people, whereas branches are mainly used by older, poorer, and less educated people. And here is a graph that was in the original paper, but was taken out from the version that I was sent. I don't know why, because I thought it was quite a good graph, but it's quite striking. If you look at this graph, damn it, I knew I'd fail. All right, if you look at the graph, each panel is just looking, young versus old, more versus less educated, and then in each little bit here, we have the blue is the percentage of people in that group that use branches, and the red is the percentage that use mobile app for their banking. And this is again from this FDI survey of household use. And you can see, I mean, look at young versus old. I mean, this is a pretty striking difference. 2019. We're up at like 50% mobile for the young, and just over 10 or 15% for the old. Just out of interest, how many people here with gray hair ever go into a bank branch if they can help it? So I mean, I believe the survey, but it suggests to me, I don't know whether it's something about university towns. Yeah, I never go to a bank branch. I also don't use a mobile app. If I'm near my computer, I don't use my mobile app because my. Because we don't have money. That may be it. So there's something funny going on here, but the funny thing might just be that we are not representative of the average population in the US. But anyway, banking online to me is sort of perfect. My stubby fingers are fine. I can see lots of stuff on the screen without squinting. Anyway. We'll take this survey as a correct summary, but also we see big differences for more and less educated and high versus low income. So there's definitely big differences, maybe not in university towns, but around the rest of the country in how people use their banking. Okay, so that's where we got to. So what? Well, so as fintech progresses and makes its way into the world, what happens? More consumers shift from branches to digital. Fine, makes sense because you don't have to get in line, you don't have to talk to people. There are almost no downsides. Now, in return, because no one's going into the banks to stand in line and chat to the teller anymore, the banks close branches.
My bank, BNY Mellon, they only have one branch in Pittsburgh.
Okay. Yeah, yeah, exactly. And I have accounts at banks that don't have branches anywhere. 10. Okay, we'll be fine, I think. Now, the issue though is that because this is not affecting all segments of the population the same way, the groups that are left behind, not us, but whoever those people are, the groups that are left behind can be taken advantage of by the branching banks because now the branching banking sector is less competitive. At least that's the story. And empirically, we find some quite striking results. As an example, and we saw a lot of this. It's just summarizing a few of the results. I'm not going to spend a long time going over repeating the results. But after a 3G expansion, we find that the banks that are non-branch reliant, so basically branching represents a smaller fraction of their overall deposit base, they close more branches than branch-reliant banks. Also, in terms of pricing, we see non-branch reliant banks lowering their prices while branch reliant banks raise their prices. So in keeping with this idea up here. And this was kind of striking, actually. I mean, this whole thing about financial inclusion. There was this survey at the end which says that if you look at consumers with a total family income less than $30,000, after 3G penetration, the unbanked rate of senior households goes up by 42%. Well, that is not a small number. So there's definitely some, overall, clearly fintech is sort of making things better for the average person, but that is a pretty striking result. All right. And then we do this diff in diff. We do, branching and pricing are related to the level of 3G expansion. We look at the county level, at the bank county level. But I have a question about whether this is the right geographical segmentation to be using. And this actually applies, I don't know about equally well, but certainly to the previous paper as well. And just a little bit of a history lesson. I didn't know this until I started writing this paper and thinking about it, but not this discussion. There was a Supreme Court case in 1963, US versus Philadelphia National Bank, which established that banking was subject to the US antitrust regulations. And as part of the ruling, the Supreme Court also said that banking was a local activity, and that apart from things like national credit cards and the like, when we think about competition in banking, it should be done at the local level, and that's basically continued to affect how we measure banking competition, regulators, researchers, and so on, pretty much to the present day. Now, what am I doing? That way. It's not clear that that's correct. And there's increasing evidence that large banks actually don't compete at the local level, and that they set uniform rates across quite large regions of the country. And I will give, if I can, and so what does that mean? Well, it means that local competitive conditions are actually not particularly relevant to their pricing decisions. Now, in aggregate, they're going to affect their national or statewide pricing decisions, but comparing one county with another county and looking at their relative competitive situation, if the bank is making decisions at a statewide level, may be something that we want to think about. And this comes up, and we heard this in both the previous paper and in the previous discussion, in discussions of monetary policy and how that works through the banking system and bank antitrust policy. And just to give you a bit more sort of background on this, there is a very recent paper, Beganow and Stafford, and their conclusion is large banks are especially likely to use uniform rate setting policies, blah, blah, blah. 2006, B of A, a rather large bank, set a single deposit rate per product for all of their Massachusetts branches and only 3 distinct rates for all the 6 states in New England. Now, this is a new paper, but it turns out this is not a new point. It appears to have been forgotten in the literature, but it's not. But it actually the first record I can find is a paper by Radecki in 1998. This was about antitrust, and it was talking about why these local measures are not the right antitrust measures. Many banks set uniform interest rates for both retail loans and deposits across entire states or broad regions. Beale, 2002, same thing. Park and Penaki, this was an RFS paper in 2009. Large multi-market banks set retail deposit and loan rates that tend to be uniform across local markets. Others. And if watching mixed martial arts bouts on TV has become too tame for you, you might seek out this one. Drexler, Savov, and Schnabel have a comment on the Beganow and Stafford paper, which is somewhat forceful. Okay, yeah, that's fine. And the key thing about this is, of course, as we saw in the previous paper, in the previous paper, if you can't make out my cleverly selected black on black color scheme here, Big banks have become a bigger and bigger and bigger portion of the total banking industry in this country, and so the point that I was just talking about affects a huge preponderance of all of the banking in this country. Okay, so that's the sort of the one issue, which is the local versus national or regional competition. The other is about this lightning as an instrument. And as we heard again in both papers and in banking literature in general, a big question is about endogeneity. You want to show that banks doing something causes something, but in reality, of course, banks don't randomly make choices about whatever it may be, a new product or a new location or whatever. That's all endogenous, and in this case, we've got another layer of endogeneity, which is that 3G expansion is not exogenous and random. It's people are making decisions about expanding for particular reasons. So what they do is they use nothing. There we go. Fine, we know what endogeneity is. So what they do is they use lightning as an instrument for 3G expansion. And my first reaction was, what? But it does make some sense, and it's described in the paper. The basic idea is that if there's more lightning, it's more likely to damage the infrastructure. That's going to lower your expected profitability, and so you'd rather expand somewhere else first. Okay, that makes some sense. But I do have a question about it. So as a good discussant, I went to talk to the experts at Wikipedia, and I found out that lightning frequency depends on things that I guess I could have worked out. Things like location, climate, and season. And then I sort of thought back to A-level physics. I don't know, James knows what that is, but I'm not sure the rest of you do. But it also depends on things like the conductivity of surfaces and on their curvature, which affects the electric field around the area, which is why lightning rods have pointy tips and things along those lines. What does all of this mean for the paper? What it means about this paper is that these characteristics could in turn very likely be correlated with individual characteristics, which in turn could be correlated with what the banks want to be doing anyway, even in the absence of 3G. And so that exclusion restriction, I'm not 100% sure. I mean, just as an example, things like, do you live in Florida? Obviously, the paper was at a much sort of narrower geographical focus than whole states, but do you live at the top of the hill or the bottom? Well, that's probably got something to do with, if you can afford to live at the top of the hill, you also are more likely to be hit by, your house is more likely to be struck by lightning, so there's a certain amount of connection going on there. Do you live in a tall, pointy building with a metal roof? Just as an example, this is not particularly relevant to the paper, but it was on the Wikipedia page, I thought it was interesting. Kisii, an urban center in Western Kenya, 30 people die per year from lightning strikes. And one of the main reasons is that they have lots of metal roofs in this area. And so again, it's sort of the rate of lightning strikes is telling you something about the individuals that live there that may in turn be telling the bank something about what they ought to be doing next. I found out lots more interesting facts about lightning, but let me see, shall we? I'll tell you something. So it turns out that how much more time do we have for lightning facts? All right, we'll ignore the international lightning facts, but the national lightning facts. Florida has 14 of the top 15 counties by lightning strikes in the US. The West Coast has the fewest. The Empire State Building is hit on average 23 times per year. 27 deaths on average per year from lightning strikes. And worldwide 2,000. And in the US, your odds of being struck by lightning in your lifetime are about 1 in 15,000. So, there are other things that are of that order of magnitude, but it's not something most of us ought to be worried about. All right, so final comments. First of all, what about banking via computer? Again, this is obviously about me, but I don't like going into bank branches or using my phone. Now, my daughter uses the phone all the time. I get that, but I'm not sure what just including this as one of the things that we might want to think about seems useful. Also, large banks typically are more branch dependent, mostly because they've been around a lot longer, and so the bank branches have been there forever. And so what should we expect if this story holds up? That new and small banks are going to be taking the tech-savvy investors away from the large banks. But at the same time, as we've seen in both presentations today, large banks' share of the total market has been increasing over time. Now, of course, there's consolidation and stuff going on that could be explaining that, but at least it's something worth thinking about. And then maybe my biggest gripe about the paper is that it defines being over 55 as old. And I get that, you know, to you at this stage of your careers, we may seem that way. And, you know, when I first started coming to this conference, I thought that too. But if you just keep coming to the conference, see how you feel in a few years. Anyway, so overall, I think this is a great paper. There's a lot of important and interesting stuff going on. You know, striking results about possible negative implications of the rollout of new technology caused by the sort of endogenous response of the institutions in the market to differential take-up of the new technology. I have some questions, but the paper's message is convincing, and thank you very much for the opportunity to read it. And most of all, thanks again. As the last discussant, let me just give a big thanks to Avner and Jim for putting on another wonderful conference, and I hope to see you all next year. Thank you.